This is Andrew Griffith at the University of Tennessee, Institute of Agriculture, Department of Agriculture and Resource Economics, livestock economist. A topic that I think is pretty important in the beef market is the futures market. And a lot of people think it's a pretty daunting topic, but it's really simple, and it has some uses that producers can utilize without ever even actually participating in the market. But let's start with what most people know about marketing cattle, that you can physically market cattle any day of the week, and there's different markets across the state and across the country, but there's always a market selling cattle, and so that's number one. The second thing that a lot of producers are familiar with as far as marketing cattle is using forward contracts. So that's a way of marketing cattle several months down the road in the future, but actually maintaining those animals at their farm for several more months. So if they have a price that they like today, they can sell the cattle, but then maintain and continue to grow those animals for 2, 3, 4 more months down the road. Something that we need to think about, though, is the futures market and how can it be utilized. So the primary purpose of the futures market is so that it provides an efficient method of managing price risk in a standardized manner. So it provides another tool. It has several uses, but the primary tool is managing risk in a standardized manner, whereas with forward contracts, we may not, or handshake deals with other producers, we may not have a standardized method or way of managing that risk. So when we're thinking about futures contracts, and in the cattle business, there's two that are associated strictly with cattle. And one is the live cattle contract, which is for finished cattle that are ready for harvest, and then feeder cattle contracts. And feeder cattle contracts are probably more common in Tennessee, but there are people in this state and across the country that have cattle on feed, and so a live cattle contract may be more appropriate for those people. But we have to remember that these are just electronic markets that run parallel to the local cash market. So if these markets are improving in price, then we would expect the local cash market. Similarly, if the futures market is declining, we're expecting that cash market to be declining. But in reality, that they're moving parallel, and the benefit of the futures market is it allows us to try to have an idea of what prices are going to be, 3 months, 6 months, 9 months, 12 months down the road, and if we see a favorable marketing opportunity or a favorable price today, we can use those to manage that price risk and maybe go ahead and capitalize on some profit potential. And the reason why this is important is because most times producers base their marketing decisions on expected prices. So if we expect prices to be higher next week, well then we might hold on to those cattle a little longer to garner a higher price. And so that's how the futures market can be used. So the three primary uses of the futures market is, number one, it shows the direction of prices. So from today on, we know what the direction of those prices will be. Number two, the expected price levels. Are they going to be higher? Are they going to be lower? And then number three, price transparency. So remember, those three things is what we're looking at. So if you need any more information on futures and options or beef or forages, just go to utbeef.com. And until next time,